Hello and welcome to Asking for a Trend. I'm Josh Lipton, and still with me right now is the great Adam Johnson, Bullseye American Ingenuity Fund Portfolio Manager. We're going to take a look here at shares of Coinbase this week as it began with the platform reaching a major milestone, announcing its addition to the S&P 500. But then things took a turn for the worse yesterday when the company disclosed a significant cybersecurity breach, confirmed an ongoing SEC investigation regarding its past user metrics. Joining us now to break it all down, the latest is what he calls Coin's no good, very bad day. That would be Mark Palmer, Benchmark Company Managing Director, Senior Research Analyst of FinTech and Digital Assets. Mark, it's good to see you. So there is a lot to break down here, Mark. All right, so they're added to the SPX. That's it. That's a big achievement. It's a big milestone. But then, Mark, we have this headline-making hack. Maybe start there with the hack. I mean, your takeaways from that, Mark. How concerned should investors be about that?
Yes. Well, first of all, thanks very much for having me on. You know, the situation with Coinbase is really something of a one-off. You know, what we're talking about are consultants that were hired by the company for customer service abroad. And the cyber hackers, in this case, got a hold of these people and bribed them to provide them with access to Coinbase's platform, at which point they were able to access a lot of different materials about customers' backgrounds, but importantly, none of the log information, none of the private keys associated with crypto, and you know, none of the access to customer wallets. So as a consequence of this, you know, there were no actual, you know, big amounts of money that were lifted off the platform, as you typically will see with some of these hacking incidents. With that said, you know, it's always a concern when an exchange has a breach, but management moved quickly. They came out with all of the information about what had happened as fully as they could, and they had a remediation plan in place, which would ultimately help to compensate any of those who are impacted by this, you know, to the tune of between 180 and $400 million. So it's a bizarre story, but it really didn't have anything to do with the various cybersecurity protection measures that the company has in place. This was really more of the real world type of incident that we're talking about here.
Yeah, it's absolutely mind-boggling, Mark, that this would happen, that you would have bad actors that are such bad apples. And yet, yeah, I think you're absolutely right. The company took a very hard line, and the stock was up 9% today. You know, I own the stock, and it's very hard to try to figure out how much money they're going to make this year because it's a function of the price of Bitcoin. But if we say it's somewhere between 12 and 15 bucks and you put a 300 multiple on that, you get somewhere between $360 and $400 on this stock, and it's trading in the 200s. So for me, I'm very comfortable. How do you look at it?
Yeah, I agree. And, you know, we have a buy in the stock. We have a $301 price target as of today. I look at Coinbase as being one of the best ways, if not the best way, in the public equity markets to play the institutional adoption of crypto. And crypto is that odd asset class where retail investors have taken the lead and institutions really haven't followed. And the reason for that is a lack of regulatory clarity around the space. Institutions didn't want to get heavily involved until they understood what the rules of the road really were. Now, that kind of clarity is already in place with the changes that we've seen at the SEC in the U.S., but we expect that with some of the legislation that's been proposed, both for stablecoins and for crypto market structure, you could see even more clarity on the way. Coinbase has an exceptional crypto-focused prime brokerage platform. It has agreed to acquire Deribit, which is the world's largest options platform in the biggest crypto deal ever. It's going to close later this year, $2.9 billion deal. What does it give Coinbase? It gives them a lock on the derivative space. And the primary way through which institutions like to express views on crypto is via derivatives. So really a game changer for the company. The setup here, we believe, is very, very good.
Mark, the other headline I would like your take on, and we mentioned it, I think, in the intro there, that SEC investigation into past user metrics. You were telling your clients, what about that, Mark? Is that cause for concern, a nothing burger? What do you think?
I think nothing burger is a good way to put it. What you have here is a case that is a holdover from the prior administration and the SEC when it was under the management of Gary Gensler, who was conspicuously against the crypto space, actually had a big lawsuit against Coinbase that was more expansive than what we're talking about here, that was dropped back in February. This is about what are metric known as verified users. And the lawsuit has to do with claims that Coinbase made at the time of its IPO in the spring of 2021 with regard to how many verified users were on its platform. The thing is, Coinbase hasn't even used this metric in the last 2.5 years. It has moved on to monthly transacting users, which is a better metric. Really don't see how Coinbase could in any way remediate this situation. It's already been remediated. And we fully expect that, you're going to hear that the SEC has dropped this case as well, probably in the not too distant future.
Mark, always great to see you. Appreciate your time and your insight. Thank you so much.
Thank you.
Stick around. Much more Ask for a Trend still to come. S&P 500 notches a 5-day win streak as Wall Street shakes off trade war worries. And here with the trading day takeaways, we got Yahoo Finance's Jared Blickery. Jared.
Thank you, Josh. To the moon, right? 5 days. And the stat I love is that the NASDAQ Composite and the 100 have been up 3 of the last 6 weeks, more than 6%. And the question is, for investors, has it gone too far, too fast? I tried to answer that, and I drew up a number of stats. So look for the complete hit on the Yahoo Finance website. But this is kind of the summary. So I have 3 bars here, and they're representing 3 different strategies. In green, which is these first bars in each of these sets, if you buy at any random day, basically since 1985, and you held for 1 day, well, you'd make virtually nothing. 1 week, a little bit more. And I'm looking at the green here. 1 month, you start to see some decent returns, and then 2, 1 quarter, 2 quarters, all the way up to 1 year, and then you're approaching 20%. So that's what you would normally buy just by throwing something at a dart and saying, let's buy today. Now, what happens when the NASDAQ 100 becomes overbought? And I use relative strength indicator. I've gone through this several times here before, but basically, has it gone too far, too fast? Well, when that happens in white here, we see returns are a little bit less sometimes than the green line. So less than average in some, but a little bit more in some of these others, especially long-term. 1 year, a little bit less than the average. So that's not the greatest strategy, but it's certainly not telling you to sell. Now, what we have here is not only the NASDAQ 100 itself overbought, but the internals, the components of it. Something north of 57% of the 100 components are north of their 200-day moving average. That is coming from an 11%. So from 11 to 57, that indicator itself has become overbought. So when we have both of these conditions, guess what? You see supersized performance going out 1 year. In the near term, like 1 month, 2 weeks, 1 day, things can struggle a little bit. So we might be a little bit due for a tiny bit of a pullback, but in the long term, it does not pay to sell right now.
Now, viewers who are watching this, Jared,
Yes.
before they begin to, before they slam the buy button, what are some of the risks they need to think about?
Well, here's what I'm looking at. Here's another thing. The 30-year yield has been touching 5%, and that is the danger zone. It has not gone above materially, and it did a little bit ago, and I'll show you a chart right here. Here's 2023, and we can see in late 2023, it poked above 5%, but then it came straight back down. Didn't quite reach it in 2024, but now it has touched it several times. Let me show you a 2-year chart with candlesticks, and you can see this has been like an electric fence. Touched it precisely here at the beginning of the year. Then just a few weeks ago, and then yesterday. but it has backed off. The thing that troubles me a little bit is that the pullbacks here, what we're seeing, these downdrafts after the reactions have gotten smaller and smaller. So what happens if the 30-year goes north of 5%? And that is what happens. So if it's based on inflation worries, then we get an inflation pop, and then commodities should be leading while stocks kind of chop around. That's this scenario here. If it goes over 5% because real rates are rising, well, that kind of shows you that the Fed might need to stand in. That's when you have PEs compressing. That's when tech lags. And then if we stay under 5%, that is the soft glide scenario. And this is how we see the broad rally kind of sailing on. So we want to see the 30-year stay under 5%. But if it doesn't, we could see some trouble ahead. And exactly how it plays out, well, we'll have to see.
Before we go, let's get your take on gold. The yellow metal, is it still a safety trade?
Yeah, gold is putting in an M top. That's kind of a technical thing, and I'm going to show that real quickly here. I like gold. It's up about 22% year to date, and let's check in on it right now. It's still up 20%, but look at that. That is an M top right there. And so technically, it could sell off from here. If it pops back above, well, probably going to test those highs and go beyond. But in the meantime, Bitcoin has just been racing higher. It stopped a little bit, but the trend is nice, and we'll see if I can find it here. If not, you're just going to have to take my word for it. 105,000, 107,000 is a record. We'll have to see if it breaks it soon.
What's on your screen this weekend? Is it Bitcoin, greenback?
You know, I'm going to take a nice long nap. It's been a long week.
It's a wise policy.
Thank you.
Thank you, Jared. Stick around. Much more Ask for a Trend still to come. Well, single-family housing starts and building permits sliding in April. This comes as home builder sentiment also saw a decline in May, falling to the lowest level since 2023. And while tariffs cast a cloud of uncertainty for housing, affordability continues to be a bumpy road for potential home buyers. Lance Lambert, ResiClub co-founder and CEO, joins us now to discuss. Lance, it is good to see you. I want to drill down, Lance, to start on this issue of affordability, because I did see this interesting report this week. I don't know if you saw this one, Lance. It showed that middle-income home buyers making $75,000 could afford just 21% of the available listings nationwide in March. And that was compared, Lance, with 49% in 2019. So I guess to start, walk us through what is going on there, Lance, and then more broadly, when do you expect to see affordability improve here?
Yeah, so when taking into account home prices, mortgage rates, and incomes, affordability is stretched at about almost the worst levels in about 3.5 decades. 2023, when rates got up to 8% for average 30-year fixed mortgage rate, was a little worse, but affordability is very strained. And unless, home prices were to fall meaningfully or mortgage rates were to come down 1.5 percentage points, affordability is going to be in this strained environment. And so right now in the market, that's created additional choppiness for builders right here. It's still constraining turnover in the resale market. There's not many transactions happening for existing home sales. And there's a lot of home buyers still on the sidelines.
Lance, Adam Johnson here, and let me just sort of, play the devil's advocate or pick this apart a little bit. I think you're right that if rates come down, obviously by definition that makes homes more affordable. But my feeling is that there's going to be a feeding frenzy because there's so much pent-up demand. And so what you got on a lower mortgage, you're going to give up because you're probably going to be having to bid higher for that house. Do you see any truth to that?
Well, so let's say that there was a meaningful affordability improvement tomorrow in some of the markets that are still tight in the Northeast and Midwest, that would, unlock more of the buyers, and those are still tight markets. But in a lot of the country, if there were to be an improvement for affordability here, it's not necessarily going to open up the floodgates because there is building active inventory, especially in the Sun Belt, these Gulf markets, where if, mortgage rates did come down, almost a percentage point, it would unlock some demand, but those markets have still weakened and they're not, this isn't the pre-pandemic market.
What are we seeing? I'm just interested, Lance, broadly with pricing. Is it sticky? Is it coming down? What are the trends?
Yeah, we're seeing a deceleration across national home prices. You look at the indices for Case-Shiller, Zillow Home Value Index, CoreLogic. We're seeing that decelerate. It's still up 1-2% on a nationally aggregated basis, But in some of the Gulf markets, Mountain West markets, you are seeing it begin to roll over for prices, especially Southwest Florida, Cape Coral, Punta Gorda, Naples. Those are all markets where prices are falling right now. San Antonio, Texas, Austin, Texas, those are seeing falling home prices. The tightest markets and where prices are kind of still inching up a little bit this spring are some of the areas of the Northeast, Hartford, Connecticut, parts of New Jersey, parts of the Midwest. The Midwest and Northeast are still the tightest. The West was still a little tight last year, and then it's gotten a little choppier this year. But definitely the weakest part of the country is the Sun Belt and specifically the Gulf.
Lance, I'm looking at the 30-year fix, 6.92, according to Mortgage News Daily. I'm curious, Lance, as you try to model that out, where do you think it could be 6 months from now, 12 months from now? And what's the level, Lance, that you think would really get people excited and in? Is it 5, 6, 5? How do you think about it?
Here's the hard truth, is that mortgage rates might not be coming down like people have been expecting. And forecasters have been expecting it for 3.5 years now, and mortgage rates have proven fairly sticky. And the thing is, when you account for economic growth, when you account for inflation, these mortgage rates aren't that abnormal for where the environment is of the broader economic, where the broader economy is. Now, if we were to see a recession, we were to see unemployment shoot up, it's likely that the long-term rates, long-term yields and mortgage rates would come down. But otherwise, this is kind of the environment we're in.
And last question, Lance, inventory, trends and themes you're seeing there.
Yeah, so we're seeing active listings and months of supply rise across most of the country. 95% of markets are seeing inventory rise year over year. And nationally, we've been seeing inventory rise for about 18 months year over year, and we're up about 30% year over year. Now, we're still a little below pre-pandemic levels. We're about 15% below for national active listings, and that's everything on the market for sale, condo, single family. But in the next 4 to 5 months, we are going to cross over and get back to 2019 levels for active inventory. And then the real question becomes from there, does inventory continue to rise, right? Does this constrained affordability environment continue to see active inventory for sale rise? And if that is the case, next year, next spring, in even more markets, buyers are going to have even more power than they did this year. Now, I'm not saying that buyers had a lot of power this spring, but they gained more leverage this year, and especially in those Sun Belt markets compared to the past few years.
Lance, great to see you today. Thanks so much for your time. Appreciate it. Time now for To Watch in earnings. Next week, we're getting another batch report throughout the week. Looks like home is where the heart is. There will be a good concentration of home improvement retailers, including Home Depot, Lowe's, TJX. We're also going to be hearing quarterly earnings reports from big box stores like Target and BJ's. Investors are opening the door to Home Depot's Q1 data on Tuesday. Analysts expect it to beat earnings estimates, with top-line expectations anticipated to be $39.3 billion. And despite the UP ups and downs of recent tariff policy, analysts are optimistic. The company has surpassed Wall Street earnings estimates in the last 4 quarters. Then we've got Home Depot rival Lowe's. They're scheduled to release its quarterly earnings report that's coming on Wednesday. Revenue estimated at $20.95 billion. That number down nearly 2% from the previous year. And we'll watch Wednesday when Target is set to release its first quarter earnings. And they may be weaker than expected, with revenue slated to be nearly flat at $24.4 billion. Stock has dropped over 26% year to date. The big box store is under pressure by weak consumer spending, supply chain issues, and tariff impact. Well, that is a wrap on today's Ask for a Trend. Our big thanks to Adam Johnson for hanging with me today. Adam, final thoughts for the viewers?
Yeah, I think for people who feel like they missed the boat, right? They didn't buy that bottom back on April 2nd. It's okay. There's plenty of time. We're not trying to time the market. Focus on time in the market, not timing the market. And as I look ahead, which is what matters far more than looking over my shoulder, I see so much more to like than to fear, Josh. We have earnings, we have employment, we have an economy that's stronger than people think, and we have inflation that's coming way down. That was the message from the inflation data this week. You add all that up together, yeah, there's plenty of upside for this market.
You know what? I always love having you here because I appreciate the energy, the insight, and the optimism.
Oh, thank you, sir.
You got it. All right, be sure to come back Monday at 4:30 p.m. Eastern for all the latest market moving stories affecting your wallet. Have a great weekend.